iWIN TV. See what others can't.
Welcome to the third edition of the weekly investment news show, iWIN TV. Where you win, because we use algorithms, not people, to select stocks and manage risks in the markets. We're the robots you can trust.
Why watch the talking heads on TV? Who might have a hidden agenda when algorithms have been shown to make better decisions?
Which company can you find out there that has a record as consistently bad as this one?
If our markets are down 25% and gold is up 50%, it wouldn't be a total shock.
Get those old voices out of your head and start watching iWIN TV to get better results from your investments.
Today we're going to cover stock selection followed by risk in the equity markets and interest rate risk. Then we'll introduce a new segment called How to Invest Better, to help you with your investment decisions. Past performance is not an indication of future performance. Please pause this video and read the disclaimer.
First, let's talk about the current 50 stock portfolio selected by natural selection algorithms with a bias toward growth stocks. As you can see, there are currently 41 stocks in the portfolio with 90% winners and 10% losers. To be fair, the percentage of losers has gone down this week, because most of the stocks sold this week were losers. The average winning return is 37%, with the best stock Nvidia returning 530% since it came into the portfolio about 2 years ago, followed closely by AMD, which is up 528% since it came into the portfolio about a year and a half ago. The average loss is 4%, with the worst stock BlackBerry losing 8% since it was purchased a month and a half ago. Here are the recent buys and sells. The natural selection algorithms went on a selling spree and sold ArcelorMittal, Melco Crown Entertainment, Goldman Sachs, Deutsche Bank, KeyCorp, Regions Financial Corporation, Huntington Bank shares, SLM Corporation, Barclays and United Continental Airlines. The only buy this past week was the multimedia technology company Activision Blizzard.
Hey Sharon, it looks like the algorithms went nuts on selling the financials.
Yeah, Ryan, maybe if those talking heads on CNBC noticed stuff like this, they might have something useful to talk about. So now for a read of the equity markets. In general, the equity markets continue to show relatively low risk with the exception of the Nasdaq and Russell 2000. Both the Dow Jones Industrial Average and the S&P 500 are measuring at very low risk, while both the Nasdaq 100 and Russell 2000 continue to show slightly elevated risk. The risk metrics for the Nasdaq 100 have degraded slightly this week, while the risk metrics for the Russell 2000 have been relatively flat since our broadcast last week.
And now let's talk about the current interest rate environment. Our measurement of interest rate risk shows interest rates transitioned to low risk over a week ago. Your government treasury investments should be fine for the near term.
This is our new segment about how we can help you invest better by showing simple portfolio strategies that should provide better results.
For today's Invest Better segment, we're going to talk about the best way to manage your 401k, 403b, or other retirement account.
Financial institutions and experts overcomplicate your portfolio to make it look like they know what they are doing, but we have proven these complicated portfolios take away the potential returns, while leaving most of the risk of loss, as you can see from these three portfolios as we move from conservative to moderate to aggressive. You don't get more return as you take more risk, but you get additional loss or drawdown. This does not make sense, and even we robots can spot the foolishness in this way of managing your money.
Today we're going to show you a simple, better way to invest your 401k, 403b, IRA, or other retirement account using to exchange traded funds, also called ETFs, or by using two mutual funds instead. The only two components you need to diversify and protect yourself are 1. Bond funds or fixed income funds, preferably that invest in U.S. government treasuries, and 2. An equity fund that invests preferably in the S&P 500 index or other large-cap strategies.
Now when we use ETFs and go from a conservative to moderate to aggressive portfolio allocation, the relationship between risk and return makes more sense. In other words, you get more return for taking more risk. You get most of the return, and in some cases more return than the S&P 500, but you get much less of the loss or drawdown. And by the way, this way of managing your money runs rings around those target date funds lurking in your retirement plan offerings. Stay away from target date funds. They are bad investments. Click on the link in the comments to learn more about why.
And you can do the same thing using mutual funds like the Vanguard funds shown here, to create conservative, moderate, and aggressive portfolios with a healthier risk and return relationship. This is not a paid endorsement by Vanguard. We are robots and don't care about money. That is all for this week, July 29th, 2017. If you enjoyed watching our new iWIN TV channel, please subscribe below and leave a comment. Until next week, we'll be watching the markets for you, to bring you the latest opportunities and risks. Thank you for watching. Please subscribe to get better results from your investments.
iWIN TV, see what others can't.